And joining us this morning from San Francisco, we have George Feiger, CEO and President of Contango Capital Advisors, with us. George, good to have you back. And first off, your thoughts on Facebook.
Well, I have nothing new on Facebook, but I give advice to all retail investors that they shouldn't be buying into IPOs. It's a very bad strategy. If you like the company, wait 12 months, and statistically, you'll get it for a lot less. And there's a real fundamental reason for that, which I think every retail investor needs to understand. 2 or 3 decades ago, you took a company public because you needed capital to grow and expand. Today, you have the private equity industry and the venture industry, and they provide capital, just as they did for Facebook and Google and many others. So the purpose of an IPO today is not to raise capital for growth, it's to let the insiders cash out. And if you think about that for 5 seconds, you're going to ask yourself, why should I be the one who helps them cash out?
Well, insiders have been cashing out the Facebook IPO. That includes Peter Thiel, of course, one of the original angel investors, and Goldman Sachs. But what a difficult market environment to list. I mean, right now you have people running for the hills and cashing out of the market itself.
Yes, but again, if you take the investor's point of view, I tell every investor who's qualified to be a qualified purchaser in the U.S. context, if you want to get an equity investment in growth opportunities, go into a private equity fund, go into a venture fund. Your odds are much better than buying into these kinds of companies when they go public, whether the market is generally good or generally bad.
Okay, well, you know, taking a look at the broader markets, George, we've seen more than $3 trillion erased from market value from equities worldwide because of the problems in Europe. And you say Greece is going to exit the euro by the end of this year.
Yes, I mean, there are 3 really good reasons. First, the debt of the Greek government is simply insupportable. It's just too big and there's no way to repay it. Second reason, the austerity being forced on the Greeks, on the Greek economy by the European Central Bank and the German government is making the situation worse and not better because the economy is shrinking and the deficit is actually growing. And thirdly, the Greek population, the voters, have made it abundantly clear that they're not supporting the austerity. They voted in, well, they haven't voted anyone in, actually. They've had a hung election. But the voters have given enormous power to parties on the extreme right and the extreme left, and there's social unrest. So Greece is cooked, and the only issue is exactly when it leaves, and more important, the form. If it's a managed departure, you can prevent a massive disaster in the rest of the Eurozone. If it happens in an uncontrolled way, it will get very bad.
And what about the contagion effect to Spain right now? I mean, that's a focus, especially after Moody's cut their ratings on Spanish banks. People are talking about a bank run. You have yields on the Spanish 10-year note inching closer and closer to the break line of 7%. I mean, things are all looking pretty bad across Europe.
And it's even worse when you realize that in Spain and in Italy, the funds that have gone in to provide liquidity to the banks have in fact been used to buy government bonds. So it's as if you pulled yourself up by your own bootstraps. The banks are supporting the governments, but the governments are supposed to be supporting the banks. This is also an unsustainable situation in its current form. So either the whole structure collapses because of the internal contradiction, or the European Central Bank has to break its rules and literally buy trillions of dollars worth of government debt and put a line in the sand on the other side of Greece. Greece will be the example of the terrible things that will happen if you leave the Eurozone, and the rest is going to be a massive scramble to prevent that contagion that you're referring to.
Okay, well, given your predictions in Georgia, what are you doing in the markets?
Well, we have focused very heavily on the U.S. for some time. Our equity investments have been very heavily in U.S. blue chips that pay dividends. Our bond investments have been very short duration, very high credit quality. We've invested in some things that look good, like natural gas and so on. That's a great opportunity. But by and large, this is a cautious position. We're waiting until things become clearer, and because we have the short duration fixed income positions and the conservative equity position, we're in a good position to change these allocations into something more interesting and opportunistic when we see how things break. But they're not very clear right now. Caution, I think, is advised for everyone.
Yeah, you bet. George, thank you so much for your time today. Have a great weekend. George Feiger, CEO and President of Contango Capital Advisors.